Assalamu alaikum, good afternoon, and thank you for joining us today. We're excited to host this educational webinar as part of our ongoing effort to highlight new and emerging opportunities in Islamic finance, as well as deepen the community's understanding of how to invest with clarity. Today, we're joined by Aliredha Walji, CEO of ShariaPortfolio. Throughout this presentation, you're welcome to submit your questions directly via the Zoom Q&A box. We'll reserve time at the end to address as many of them as we can. Quick disclaimer before we begin, this session is for informational purposes only and should not be considered investment advice. Please do your own due diligence before making any financial decisions. With that being said, I'll hand it over to Aliredha to get us started.
Thank you so much, Saad, for this opportunity, and we are really grateful for everybody that has tuned in to this program. I am just trying to get our slide deck up here, so bear with me. And I am really excited about engaging with you all and getting a chance to present on this timeless topic, because a lot of people do think about how to build a strong portfolio, a resilient portfolio that can weather the ups and downs of the market. But a lot of times we just need the right tools and the right framework and mindset to be able to put that into action so that we can position ourselves to be in a strong financial standing and achieve our financial goals. So since I'm running into this the slide sharing challenge on my end, Saad, if you don't mind, can you just put the deck on your side and I can just drive with that? For some reason, the deck is just not letting me screen share. So we can, inshallah, have it on your screen, and I will go ahead and dive into it. But I'm really excited about this because it took me some time to put this deck together. I had to think critically, hey, what am I really going to talk about? Because there is a lot to say when it comes to portfolio management and how to navigate the markets, and what are some timeless pieces of advice that can help investors. And so I had to, focus on the more, the points that I felt would really resonate, not just in today's world, but, anytime in the future as well. And so we really hope that these slides can come in handy and help you in your financial journey. For those who are new to us, ShariaPortfolio has been in the wealth management space for over 20 years now. We have been helping Muslims not only now in the US in over 26 states, but through our sister companies, working to provide halal investment solutions to a global audience. People from many countries are able to work with our partners in Canada. And of course, we have SP funds that I'm sure a lot of you have heard about. And today, one of our topics will be to go over some of the baskets that we've been able to develop on the Zoya platform for your benefit. So inshallah, Saad will be covering that. But my goal is to be able to go over the topics that I think will resonate with you all as we dive into the world of investing. What are the characteristics and the pitfalls that you've got to be taking into consideration so that your portfolio is set for long-term success. So if Saad, you can put together the slide deck, that would be fantastic. And inshallah, we can dive into today's program. All right, fantastic. Thank you so much. So I see that, this is the intro slide. The next slide will be our general disclaimer. And again, we are trying to build a portfolio that can help you to stand the ups and downs of whatever the market brings our way. Again, this is general investment information that we are trying to give to everyone, for specific advice to your particular financial picture. Please do connect with an advisor. We do have a team of advisors who are licensed and who can discuss one-on-one with you to determine what is a right portfolio for you as you navigate your financial goals. And inshallah, we'll be happy to speak with you. So if you are interested, we have our contact information that we can follow up with you after this program. But in the introduction of this, I thought about what is it that I can share that can hopefully leave something in your minds as we walk through the rest of the slides, right? And I felt the most important thing is to highlight patience. Of course, patience, I will mention it even more so in coming slides, But a lot of people, I think with this instant gratification world that we've been accustomed to, where you click a button and your package gets delivered to your doorstep in a matter of a few hours. And so we've been accustomed to that type of mindset, and oftentimes we have to really work hard to overcome that type of gratification, instant gratification, that we want everything right at our fingertips, right when we want it, because investing doesn't always work that way. Sometimes, you could invest in a particular company, even if it is a strong company, the results may not always materialize in the month or in the week that you invested. You, of course, have to give it some time. Just like when you plant a seed, you're not going to get the fruits instantly. You're going to have to water the plant, provide it with adequate sunshine, among other things, for it to blossom and develop into something strong and bear the fruits for you over time. So this is one thing I definitely want to highlight. Let's go into the next slide. If we can. So why do we need a resilient portfolio? I mean, we're obviously living in times where there's a lot of uncertainty out there. And I think that when we do encounter, misinformation or hype out there, we have to be able to understand, and what is it that we are trying to achieve? What is your goal as an investor? And so by coming at it with a sense of discipline, you're able to weather the ups and downs much better. And there's a classic quote that I put here. The stock market is a device for transferring money from the impatient to the patient. If you look at the chart on the right, most people would have probably freaked out at that dip, or even during COVID there was a big dip. But those that were patient and stuck around were able to realize some of the good gains that happened in the years that followed. So being patient is definitely a strong point that we want to keep in mind. Next slide. So here are some common mistakes we're going to dive into. And as the quote here highlights, right, even in the midst of chaos, even in the midst of volatility, there is always opportunity to try and take advantage of. So with that kind of in the back of your mind, here are some common mistakes that I would recommend everybody be wary of, so that you can be ahead of the curve and not fall prey to these mistakes. One of the most common ones is trying to time the market, right? So on this chart, I know it's a little bit of an eye chart. One thing to keep in mind is that this is from between 2003 till December 2022, although you could extend that even further till today. When you miss the best 10 days or the best 5 days of the market, you risk missing pretty much most of the gains. And so for those who are not sure when to catch the bottom, because that is a very hard thing to do anyways, it's just better for you to stick around and stay invested, even despite the volatility that you will encounter and the corrections that you'll encounter along the way. And most people lose money, according to Peter Lynch, by preparing for those downturns and trying to time those markets than just actually staying invested and going through the correction and recovering from it. So try to be wary of not trying to be too chintzy and trying to time the market. Sometimes it is just better to remain invested, and that will give you long-term success, historically speaking, at least. Next slide. Here's another one. When we see fear, or when we see large declines over a short time frame, we are more likely to think that the declines will continue. As a human, it's natural for our emotions to dictate, what we think is going to happen, or to make us nervous, and that's okay. We are all human at the end of the day. But what is important to realize is that when the S&P goes through some of these sharp declines over short time frames, historically speaking, according to the data here, the 1-year return following that tends to be on average up about 32%. So large declines should not be necessarily seen as bad, in the context of investing when you have some time to work with. And if you are positioned well, most likely you will recover if you give it enough time. Next slide. So here's another thing to keep in mind. I've often heard people say, look, when things are going well, investors will sometimes ask, well, why don't we just put everything into this one stock? It's doing so well. What's the point of having all these other holdings in the portfolio? Well, there's two types of risks, right? When we have those things that are in our control, like how much you're going to allocate to a particular sector. So if, let's say, there's a downturn in the energy sector, if you had a portfolio that was comprised 100% of energy or oil and gas related stocks, then you would be in trouble if there was a downturn or some kind of negative shocks affecting that industry, even if you had high quality companies. However, that's something you can control. But what we cannot control are external shocks, and those are the things that we have to be mindful of. So things like COVID, right? Nobody could have adequately prepared for something like that, and so it is our job as investors to think about the two types of risks and then decide how we want to allocate to mitigate the ups and downs that could result from these things that are known and things that are more in our control. So try to be mindful of diversification. We obviously are not recommending over diversifying. As you can see, a good portfolio does not have to be something that is comprised of tons of stocks, but be mindful of not being overly concentrated in just one name, for example, one industry, because you could be caught off guard with something that could happen in the macro environment, which could send the whole industry tumbling, for example. So when we're building portfolio, right, what are some things to keep in mind? Let's go to the next slide. Here are components of a good portfolio. Diversification, so you can pick different industries, as I mentioned, look at several, when looking at asset allocation, right? What are the industries that you want to be exposed to if you're, within the equity side of things? And then also, there is a lot of discussion among practitioners in this space that are challenging the traditional model of investing, and additional asset classes are being introduced and mentioned even by BlackRock, Fidelity, among others, for investors to keep in mind when building their portfolio. So we want to be mindful of what are these other choices: digital assets, real estate, among other things. Staying patient, as I've highlighted, I think we cannot emphasize that is a very, very important point. So you always want to be disciplined in your method, in your approach, and not try to be someone that is jumping around too much. Focus on your game plan and stick with it. Don't be at the sign of trouble you try to jump around. Focus on what you're trying to achieve and maintain that with a clear mindset. Also, long-term focus, right? So investing is not just about 2 days, 2 months, 3 months, right? Have that long-term focus. I think there's one or two other points on the previous slide, Saad. And then there's ideological investing. I'll cover in the next one. But of course, use data to drive your decisions. Don't just fall into, there's a lot of people who are paid to shill or pump different tokens. If you're looking at the crypto world and even the stock market, be careful who you're listening to, but always make decisions that are based on data and not just hype or speculation. And if you stick with that, hopefully you can have a good resilient portfolio. So in the next slide, I'm going to talk a little bit about ideological investing, right? A lot of times investors may be focused only on stocks that, on charts or fundamentals that are known, right? Looking at financial ratios or looking at technical analysis patterns to determine how to position their portfolio. But more recently, there is a term that has been circulating, which is known as ideological investing. So it's not focusing primarily just on the fundamentals, because these days a lot more goes into driving stock market price. Things like geopolitics, AI, culture, among other things, can drive value. So just yesterday, I think President Trump and the representative from Saudi Arabia were talking about opportunities for companies in the US to work with them. NVIDIA and Tesla, incidentally, were two that were mentioned, in the discussions. And so by these kinds of things at play, it is much more important to have those things in consideration above and beyond just what the fundamentals of the company say, because this will give you an idea of where money will flow, and that could potentially drive a value over time. Now, we're not necessarily saying that these are things you should all be considering, but these are some examples of disruptive and revolutionary type companies that and asset classes that are in front of us here on this chart that we all got to think a little bit critically about, because they're shaping not only the future, but also where investments can flow. Alternative asset classes are other things that we want to consider. As I mentioned, the 60-40 portfolio, where 60% historically was recommended for stocks or 40% for bonds. Of course, for Muslim investors, we would opt for Sukuk, which is the alternative to the fixed income interest-bearing bonds. But alternatives, Fidelity Research has been recommending looking at other categories. Gold, Bitcoin, among other things, are being cited as alternative options for investors to consider. So it's not a bad idea to think about what might make sense for your portfolio as you try to diversify and build a strong portfolio for different goals that you might have in mind. And of course, one of our advisors, whenever you wish, can always speak with you to ascertain what will make sense for you, because this is not a cookie cutter approach, right? Your goals, Saad's goals, my goals might be different. So we all have to approach this with a little bit of nuance as to what might make sense for each person. Next slide, we'll talk here about one of the more common ways that we have adopted when dealing with investing is to consider a core satellite strategy, where the index is comprised of index funds, right? Where exposure to, for example, SP funds gives an investor the ability to follow a broader market index. And by doing so, you're able to potentially lower, your volatility and also have a longer term approach with that. At the same time, the satellite are the individual stocks that you can introduce to the portfolio for specific purposes. And if you're following a thematic style investing, looking at things like AI, robotics, blockchain are some of the themes that you might identify as important for the next 5-10 years. And so by selecting individual companies, you can create a good balance between the individual stocks and the index funds to create a hybrid approach. And in many cases, that can work well for a lot of investors who are trying to build a resilient portfolio. So let's look at some key principles, right? In here, markets will constantly change and adapt. They will grow ever more complicated. There is a lot of interconnectedness and global aspects to the markets. And there are several principles that underlie successful long-term investing. And a lot of these have remained the same. So this is why we're trying to cover these points so that it helps you not just for today's world and today's market, but also in the future. So let's go through some timeless principles that can help you. One of the things that has been true based on the data in the last few years is that the winners will often take most of the market share. As an example, over the last 5 years, or even if you extend that longer, you will see the top 10 companies in the S&P 500 are holding almost 40% of the total market cap. And in the past, there's also some research that Bank of America had done, which showed that between 1926 and now, only 3% or 3% and some, between 3 and 4% of companies have contributed to, all of the net wealth creation in the markets. I mean, that's a staggering thing to think about. And so by positioning your portfolio towards the winning companies, you can definitely use that to your advantage, because there's clearly something to this winners takes most approach. Some people might say, well, doesn't that mean that they're becoming too concentrated or too much of a bubble? Yes, that can always be a concern, but what you can also interpret from that is that the winners are growing faster and they're able to continue getting bigger because of the resources and the moats that they're able to grow around them. And I think that over the next few years, this trend is going to continue, and we'll probably see the share of these top 10 companies only increase, not decrease over time. That's where I think that things might be headed. Next, and that's what this slide is showing, right? You don't want to be overly diversified, right? Our goal is to try and pick individual stocks that we believe have good long-term potential, and especially in our actively managed strategies. Of course, we have passive strategies as well as active strategies, and within our passive strategies, some of the baskets that Zoya will be covering will give you some idea as to what that can look like for an investor. But especially for actively managed investors, you want to try and be selective in your in what you're invested in. And you can see the share of top 10 companies has only increased over time, and I wouldn't be surprised in the next 3 to 5 years if this goes to 50 or even up to 60%. So you want to be careful of not being overly diversified as well. Next point. Here's a key one. I know as Muslim investors and those who are adhering to AOFI guidelines, we don't rely on leverage. And I would caution anyone listening to this, do not play with fire. And leverage is equivalent to playing with fire. So I just put together a quick scenario here, right? If the market were to drop 10% and you had no leverage and you started with $100,000, then guess what? Your portfolio should only drop to $90,000. Now, if you used 2x leverage, you're essentially investing $200,000 because 100,000 is your money, 100,000 is borrowed money, for example. So if in the same scenario, the market were to drop 10%, now you're dropping by 20% because you're losing twice as fast with 2x leverage if you're using borrowed money. Now, the key point here is what happens when you see a 50% drawdown, which is common in the stock market. You will often see this every few years. There will be a drawdown in certain stocks, or the indexes may not drop by that much, but if you are invested in certain stocks, you could potentially see a big drop of that nature. So if you were to decline by 50% and you use leverage, you're pretty much wiped out. Now, what about the degen traders, right? There's a lot of people who like to employ 100x leverage or 50x leverage, and this is common in the crypto world, especially, not so much in the stock market. But if you do, invest and apply and utilize 50x leverage or 100x leverage, it takes just 2% move in the markets to wipe you out. So, you take years to build your portfolio, and that can be wiped out in a matter of minutes. So I would highly caution anyone listening, do not play with leverage as much as you think you can amplify your returns when things are going well. The risks are very high when there's even a small downturn. So with that, one last point that I think is very important to highlight. I've been mentioning patience quite a bit. Emotions and investing don't really mix. I mean, investors are often going to react at the wrong times, and filter out the noise. There's a lot of noise. Headlines will often give you the impression that things are going to come crashing and burning, but majority of the time those are just opportunities, if anything, right? If you have more capital to deploy when things come down, then you can take advantage of the dips. And if you don't, many times, if you're not in need of the capital, you don't need the cash right away, then just stay put, and a lot of those things will come back up. So there's also tax advantages to selling if you need to, for tax loss harvesting sometimes, but otherwise, most of the time, if you're not in need of the cash or not concerned about the short-term nature of the fluctuations, just stick it out and you'll make your return. So in this chart here on the left, it says if you went with the buy and hold approach since 1993, your cumulative return, with buy and hold would be 1,273%. If you were waiting to buy after an up day, right? So instead of, most people wait, right? They don't want to own the market on the down days. They want to wait on investing on the up days. Then you would have only made 44% return. And if you were investing after declines, you would have made 850%. Regardless, the buy and hold beats both, both scenarios. So it's better to stay invested, and weather the ups and downs. Of course, make sure the strategy makes sense for your situation. There's different methods, there's different philosophies, there's different portfolio strategies that are out there. Even within the actively managed, you could be either a value investor or a growth investor. So understand your risk profile, understand your time frame, and you will be positioning yourself for success. One last quote on this slide, that I think, with the whole winners take most philosophy that we mentioned, and truth to that based on historical data, selling your winners and holding your losers is like cutting your flowers and watering the weeds. That's another classic quote by Peter Lynch. So sometimes we make the mistake of selling winners too fast, because we think we've made our gain and there is no more upside, only to realize that the winning stocks continue winning and we end up missing out on future gains. So be careful of that. I'm not saying the winning stocks will always win. Understand again, what is the purpose behind holding that, and always have an exit plan, right? I mean, investors should plan to lock in gains at some point. You're not going to remain invested in a stock or in anything forever. So know what your exit plan is, and then an advisor can always help with that, and that's what we are here for, to help you throughout the process. So with that, I think we have covered pretty much what I had in mind. And I think if that covers what I had, we can dive into some of the Q&A, or maybe we can get a little bit of idea on the baskets. I see Zoya baskets on the screen. Inshallah, Saad can give you guys an overview of what these baskets are. But I really appreciate you listening in so far. Hope you're able to pick out something or the other that can help you in your investment journey. But yes, let's listen on Saad's side and get to learn about these baskets.
Thank you, Aliredha, and thank you all for joining today's session. Before we move into Q&A, I did want to give a quick shout out to a new collaboration that we recently did with the ShariaPortfolio team, which I'm sure most of you are already familiar with. But for those of you who are not, I thought we would give a quick little overview of what that looks like. So Aliredha talked about the various different strategies that they use to construct their portfolios, and so we thought, hey, they are currently the providers of the largest suite of Sharia compliant ETFs in North America. And what we noticed, based on feedback from a lot of you in the Zoya community, was that you didn't really know how to invest in those ETFs together. In fact, many of you didn't even know that there were so many Sharia compliant ETFs available in the market. And so we collaborated with them to essentially create a number of model portfolios, which are available through our baskets feature. So if you're unfamiliar with baskets, baskets are essentially collections of stocks that are curated around various different themes, strategies, and ideas. And so right off the bat here, you can see that there are certain baskets that are presented by a ShariaPortfolio. You can filter for the core category, which is right here at the top, and you'll see some of these core portfolio baskets. There are a few others as well if you scroll down on the main screen, but this is a quick way to filter for them. And the idea here is to really just provide you with a template that you can start with to get some ideas for how to construct your portfolio. So typically when you go to an advisor like ShariaPortfolio, they will ask you a series of questions, assess your risk profile, and then recommend a portfolio that suits your risk profile. And so essentially what we did was we took some of those ideas and we turned them into these pre-built baskets that are managed by the ShariaPortfolio team. And you can dive in, explore them, see kind of what suits you best, and then invest in them. And so the way that it works within Zoya is that we'll show you all the details of the basket, as you can see here right off the bat, all the different ETFs that are within that basket, the templated allocation that is there by default. You can choose to keep it as is, or you can modify it completely to suit your needs. So in this example, I'll go ahead and copy the aggressive basket. So if I click on copy this basket, it'll take me to the next screen where it pulls in the suggested weights based on the default allocation, but you can go ahead and change that. So we have a few different settings here. You can change it to equal weight, for instance, if you wanted to equally deploy your money across all those ETFs, or you could even do custom. So if you switch back to custom here, you can say, I want to do 30% in SPUS. Maybe I'm already over concentrated in technology stocks, so I'm going to remove SPTE and then equally, invest in the rest. So it's really cool, kind of the various different customizations that you can do with this feature. But for now, I'll just go ahead and go back to the default setting, hit continue. I can go ahead and give this a name. I'll keep it as aggressive for now, hit continue, and then decide how much I want to invest. In this case, I'll say I want to invest $250, hit review. I'll see all the holdings within that basket and how that $250 will get distributed across the holdings of the basket, and then hit submit order. So it's really that simple. And so I recommend that you check it out. It's a really cool feature. It's a great way to start if you're not really sure where to start. And like I said, you have the ability to customize it as you need it. So now I'll go off of camera and turn it back to Aliredha to go over the various different questions that have been coming in. I'm seeing a number of great questions already, so we'll go ahead and do that.
Thank you, Sad, for highlighting the baskets. Hopefully you guys can check them out. These were done in a methodical manner to help everyone understand what their risk profile is, and based on that suggestion, pick up certain baskets that will work for you. And of course, you still have the option to work with an advisor if you're looking for a more personalized custom solution to help you navigate, and especially for a lot of our higher net worth investors, I think that makes a lot of sense, because it goes beyond just opening an account. There's a lot more that goes into the portfolio management and investment advisor relationship that can help you. So I'd highly recommend getting the opportunity for a free consultation with one of our advisors. But I will go ahead and dive into some of the questions here that I know a common question, so I'm just picking in random. I know we will try to cover as many as we can, so feel free to keep posting. But whatever we cannot address in today's session, we will definitely make it a point to follow up with you after this session, inshallah. So recent concerns point to an AI bubble, right? With the Buffett index, the total market cap over the GDP is one of the famous Buffett indicator, as they call it. And this is how it was before the 2008 crash. So I know this is one of the things that a lot of people might be mentioning. So I definitely feel it's a good question to address here. So I like to think of, AI bubble has been going around a lot, and I've been speaking about it in some of my presentations. To think about bubbles, it's usually when the price of companies goes up, but their earnings do not keep up, right? So that's where the challenge comes in. So if you look at the dot-com bubble, when Cisco, Oracle, among others, were trading at 100 plus PE ratios, and when that was happening, these were companies that ended up obviously tumbling because it was a classic example of companies that were just going up in price, but the earnings were not keeping up. Today, with the AI companies, especially the core names like NVIDIA, Microsoft, Meta, Google, among others, when you look at the price to earnings ratio, NVIDIA actually is just under 30 right now. It doesn't scream bubble in any way, shape, or form. And so I believe that bubbles tend to happen, and the data actually does support this, when technology or when these companies go up without monetizing. When there is no ability for them to monetize, then that's where trouble comes in. But that's not the case. If you look at the revenues that they're projecting and what they've been reporting in the last few quarters, you can see that it's a healthy amount of money that they're generating, and the margins have been strong. So it tells me that there's less so of a concern about bubbles. But it doesn't mean that couldn't change over time. If it gets crazy, we'll definitely keep an eye out. But there's always going to be companies that get that just ride the bandwagon of AI this and AI that are not true AI companies, or they're just trying to get on that train, and they'll obviously suffer. In the short term, they might get some traction, but of course, longer term, that's not sustainable if they're not showing strong earnings. So hopefully that helps answer that question.
Aliredha, I'm sorry to jump in really
Yes.
quickly. So in the Q&A box, there is on the top right, it says most recent, and then you can also switch to most upvotes. So
Okay.
maybe we should switch to that and then kind of
Yeah.
go down that list.
All right, let's look at that. So some companies, including Halal, the Halal ETFs, appear to follow Halal business guidelines, but certain reports claim that those same companies are involved in activities that are linked to wars or harm, other, people in the world. How are these companies still considered Halal compliant? Good question. And when it comes to the topic of halal, ethical, this is a little bit of a nuanced space. AOFI guidelines, for example, will be very clear, and AOFI stands for Accounting and Auditing Organization for Islamic Financial Institutions. They will clearly dictate what is permissible, what is not, based on the Islamic guidelines. So, for example, avoiding industries like alcohol, gambling, adult entertainment, weapons manufacturing. These are all clear red lines we're going to stay away from. But then there's financial ratios that we have to adhere to, how much debt the company has, what about the secondary business sources, among other things. But some of the recent companies that have been in the limelight because of their support for certain countries or certain industries that might be seen in a negative light against humanity, the point is that we have to stick with what the halal guidelines tell us, number one. Number two, it's a very small fraction of their revenue. It's not like this is their primary business. So scholars generally opine on this and say, look, they're not involved in anything that would be harmful to humanity, and that's not their primary objective. Like a weapons manufacturer, it's clear that's their business that they're in. But if someone is providing IT services, and part of their revenue comes from a source that is problematic, then the scholars have generally not have not forbidden investing in those areas. So, there's BDS. I'm sure a lot of you have been hearing about BDS. We adhere to the BDS guidelines. There is a website that lists all the stocks that would be falling out of favor due to the BDS criteria. And so we definitely want to adhere to that. And we do our best to customize for our clients. I mean, clients can come, for example, pharma companies, right? Some people might have a preference to avoid certain pharmaceuticals, not because pharmaceutical companies are bad, but a person might have their own preference. And that's where our actively managed strategies can be a little bit more customizable for those who are looking to be a little bit more, filter out some of these things from their portfolios. But within the index funds, this is the way, the framework that is utilized. And we will be releasing a statement on this, on our website at some point. But I just want you to know that we're not necessarily ignoring that. Let me see here. Question: Islamic ETFs overall contain compliant companies, but fund managers is BlackRock is classified as non-compliant. Is there a conflict of interest or ethical concern when investing in these ETFs managed by non-compliant companies? So sometimes when we have Islamic ETFs, you want to know, do they have a certification first and foremost? There has to be a governing body that provides some sort of certification, right? We don't have to all have the same governing guidelines. People can follow different criteria because that's common in Islam. Through ijtihad, the struggle that comes to providing the guidelines, different scholars can differ in their views. But as long as there is a scholarly body that is evaluating the product and issuing their their fatwa or their screening and methodology and supports to say that this is compliant, I think that's a key point to mention, so that we don't have any bad actors just trying to say something that may not be true. Having said that, when it comes to launching ETFs, it is not as easy as, hey, company X wants to launch the ETFs, let's go ahead and get it done. No, there's usually a lot of intermediaries that need to be factored in. For example, there's going to be a bank that is being utilized as the custodian for the fund. There's a trust management service that is required. There is an advisory, sub-advisory side of things. So it's not as cookie cutter as you might, as people might think. And so I would say, look, try and ascertain how are they claiming to be Sharia compliant, and is there a governing body that is evaluating their product before considering investing in those? So good question. many of us investing in Sharia compliant ETFs, but there are companies like Microsoft who are compliant financially. Yeah, so I mentioned this earlier in my previous example. And of course, individual investors can take it a step further and avoid some of these stocks, from their portfolio. But in the framework of the ETFs, these are things that we've issued general guidelines on these things. I know one of our sister companies in the investment world of halal investing have also issued something. So you can check out what people are saying about this. And I think it's important to be mindful of the risks of trying to be in these things, but also avoiding them entirely. Could be a costly thing for those who cannot access halal. Because what is the alternative if you don't have a halal ETF? Are we just going to buy any other fund, right? So we want to be mindful of not necessarily, throwing out the baby with the bathwater, as you've heard about that term sometimes. Yeah, so non-compliant stocks. Why do some of the SP portfolios have non-compliant components? SPRE has 48%. So I don't see SPRE having that 48% of non-compliant stocks. We are screening for halal, and actually Saad is trying to go ahead and help answer with this one with some of the data perhaps. So Saad, let me turn it to you, and I can always shed a couple other points as well after.
Yeah, sure. I was just going to jump in just to clarify that maybe they were referring to kind of some of the details that we show within Zoya for the various different ETFs that are out there. And so typically we make this very clear in the app that Zoya follows a particular screening methodology which may not fully line up with the ETF's screening methodology. And so typically, for a Sharia compliant ETF, we'll show you that it is certified as Sharia compliant by so-and-so organization. And you can trust that it is truly Sharia compliant because their advisory board has deemed it to be as such. And so, yes, if you go from one screener to another, there will be some variances that you discover in terms of what is compliant and what is non-compliant. This is typically just due to the various different types of ratios that we look at. There might be some differences there, but otherwise, if a company or if an ETF, like Aliredha mentioned earlier, has a reputable Sharia board and they have obtained that certification, that certainly supersedes any other opinion from any other external screening provider.
Thank you, Saad. And as in the REIT category in particular, it's very difficult to avoid companies that have leverage, especially because a lot of real estate tends to be products that are highly leveraged. And incidentally, the holdings in the SPRE are very limited in the sense that I don't think there's more than like 30 or 40 holdings in there, primarily because we have to filter out the debt problem. So we're definitely trying to provide quality products that investors can take advantage of in their portfolio management or construction process. But definitely something to keep in mind as we go forward.
I also just wanted to add, Aliredha, just one more point, which is that in Zoya today, we actually cover up to 6 different Sharia screening rule books. So if you go to any individual stock, let's say you go to Apple or NVIDIA, you can see how the different methodologies stack compared to each other. So you can see that maybe it passes for 3 of them, but it fails for the other 3, or maybe it passes for 5 of them, fails for 1 of them. And so you'll often find that a lot of these ETFs where we're flagging them as non-compliant, it's based on the default rule book that we have in Zoya, which is the kind of our version of the AOFE rule book. But if you click into that stock, you'll typically find that it does pass some of the other rule books that are presented there. So just something to keep in mind as you do your research.
Thank you, Saad. I have a question I just saw on that just came, which was, I think, another very good question. When is a good time to sell a stock, right? So I mentioned this in the presentation earlier, that when you're trying to invest, always have an exit plan, because you don't want to round trip, as that sometimes happens, where you ride a stock all the way up and then you ride it all the way down. Of course, if it's a very small portion of your portfolio, you may not feel the pinch as much, but you definitely want to keep in mind the game plan on when to lock in your gains, because one of the worst things you can do is invest without having a framework. And if you're concerned about taxes, if you sell a stock, there's always different methods to mitigate some of that through a donation. For example, people can donate stock to charity, and that can avoid having the capital gains and still give you a tax deduction at the same time. So again, if that's side point, if you're interested in that, we can explore that with anyone in particular. But having a game plan means knowing when to sell, because it's knowing when it's overvalued, right? If their company is now trading at a very high price relative to the earnings, that's one way to give you a clue that maybe it's time to trim, unless data supports that their earnings are expected to keep growing, or they are trying to get into a bigger market share. They're trying to penetrate newer markets, or have a larger share of the existing market that they're in. That gives you more confidence that, hey, this could be something that we want to hold, or the demand signals are very strong. That could be another signal as to why you might want to hold on a little bit longer. But you don't always have to sell entirely, right? If you had a portfolio where you had a 5% allocation to a particular stock, and over time it has gone up to 20% or 10%, well, take some of that 5% off the table, or 10% off the table, lock in that amount, and maintain a small amount that you had started out with. So that's one way to manage that risk, right? So it's not always get out completely or go in heavily. Sometimes you need to make that balance, right? So hopefully that helps. Let's go back to the top. Some ETFs listed include stocks that are shown as questionables. So yeah, we've already talked about some of that. Someone is asking, they have 250 individual stocks. Is that too many? So when you have a portfolio that is invested in a lot of stocks, just like you would have an index fund, like SPUS follows the Sharia compliant stocks within the S&P 500. So if you are an investor and you had SPUS as your portfolio, you had only SPUS, for example, then you're going to do just as well as the market, because that's following the S&P 500 industry exclusions, Sharia industry exclusions index. So whatever that fund does, or whatever the index does, that's kind of what you can expect your portfolio to return for that year. But if you're trying to beat the market, or if you're trying to have an edge, you're going to have something different. You cannot just buy the whole basket and expect to do better than the index. So that's where the active management comes in. But yes, over time, the research has shown if you invest in a lot of stocks, your returns will be average, or pretty much in line with the market. So let's look at who's seeking income portfolio. That's a good question. What do you do for a client who is seeking an income portfolio? So when we have our asset allocation, our portfolio management menu, kind of like when you go into a restaurant, right? I like to use the spicy food analogy versus bland food. Not everybody can handle spice. I might be the type that can handle level 20 spice. Somebody else, not so much. So for different investors, there's different portfolios that can be constructed. For income-oriented investors, a value strategy might make more sense versus a growth strategy. And a value strategy, can have emphasis on more dividend-paying stocks, for example. So you're earning more dividends, as opposed to a growth strategy, which is focusing more so on capital appreciation. So there's less emphasis on the dividend and more reliance on the gains that you can achieve from the underlying stock going up in value. So that's the difference, right? That's one of the differences that you can look at when evaluating which stock to invest. Does it pay me a dividend? Does it not? And if it does, that's one way you can consider that for income portfolio. There's also income baskets, I believe, that Zoya has as well. So you can always consider one of the income baskets depending on where you are in your investment journey. That's one approach for you to take into consideration. But of course, if you're looking for a more actively managed portfolio, some of the strategies that are designed to give income can be taken into consideration and presented, and you can then think about if that makes sense for you. How many times do we trade in a year? So trading in the year is something that we want to do not as frequently, because rebalancing, yes, you want to try and rebalance, because portfolios that are rebalanced regularly, maybe monthly or quarterly, they tend to do well because the weightings can change, right? If you had an intention to have 40% in a specific asset class or 5% in a particular stock, and in the example I mentioned earlier, it went up in value, or on the flip side, it came down in value, then by rebalancing, you're able to buy more. If the thesis is still intact and the fundamentals have not changed, you can buy shares cheaper, because when things go on sale, like this suit, right? Or milk, as Naushad typically uses that example. When you go shopping in a grocery store and milk is half price, what do? I mean, I have a family of 5 kids. I don't know about you, but in today's world, I'm gonna buy 3 gallons of milk maybe. Similarly, I have to wear suits for these kind of webinars. So if Thanksgiving is coming up next week, I'll be keeping an eye out for sales. And if things drop in price, well, I'm not gonna panic. I'm gonna think, if I have extra cash, maybe I'll buy myself a suit. So that's really what you want to think about in terms of that. But trading, unless you're a trader and that's what your philosophy and that's your approach is, that's fine. But we are long-term investors. We're looking at fundamentals. We're looking at how we can benefit from different trends. And that's where we believe success can come about. So hopefully that helps. I'm going to go back to the top. So I'm picking some from the bottom, some from the top, so that we don't leave anyone out as much as possible. I know we have quite a few that have still come in. When do you know it's time to sell? We already answered that. I'm not going to answer the US CAD for now. Is there a way to take and make them halal and invest in them? Okay, so that's something I'm not going to attempt right now. Yeah, options trading, most of the scholars have opined that options are not permissible. So I will recommend speak with your Sharia scholar and ask them for their opinion. Our Sharia scholar, Sheikh Omar Khan, has generally mentioned that this is not permissible according to the scholarly guidelines. He's a mufti. And if you want to reach out on any Sharia specific questions, you're welcome to send us something at info@ShariaPortfolio, and we're happy to get one of our scholars to chime in and answer.
I did just want to add, Aliredha, to that
Yes.
point, which regarding options. There is a minority opinion of scholars that say that options trading is permissible, a very specific type of option strategy, not all option strategies. So if you search for that in Google, I'm sure you'll come across those opinions. In fact, there is a new ETF that was recently launched that is Sharia compliant, deemed by a reputable Sharia advisory board that uses an option strategy. So if anything, it's interesting just to kind of learn about what the different opinions are out there. So I would definitely recommend that you look that up.
Thank you. Yeah, absolutely. I hats off to our scholars for giving us these the answers to these questions, because it's meant to help us make our lives easier. And so thank you for pointing that out. One of the questions I saw earlier right now is, what about target date funds, right? So for some investors, who want a more set it and forget it type investment approach, right? Where you don't have the time to necessarily adjust your portfolio over time because you're busy and you're investing in a 401k plan. Especially, I think it makes sense for that type of framework. I would highly recommend checking out the SP funds, target date funds options that are available, and SP funds website does provide that in more detail. So let's say you're expecting to retire around 2050. Well, you can pick up SPTCX, I believe, gives you the ability to invest in a manner that can, the portfolio will be rebalanced over time as you get older. It will slowly shift from a heavier allocation in equities towards a little bit more of a conservative posture, so that you're set to benefit from that. So I would definitely take that into consideration. And I think I was going off of memory. So SPTBX is for a target date 2040, SPTCX is for a target date 2050. And so, this is a great way to invest for those who are looking to benefit for their retirement plans, especially for their 401k, where you're getting exposure to quality companies. And you just, as more money gets deposited, your own contribution or the match, you get exposure to the fund, automatically gets rebalanced for you, and you're able to benefit from it. So highly recommend checking that out. Um, how can I spend less time verifying? Yeah, it's a good question. How can I spend less time verifying whether a stock is Sharia compliant and spend more time analyzing Sharia compliant stocks to invest in? I think that's the question for you, Saad.
I'm sorry, could you
How
repeat the
can I
question? I'm
spend,
not sure where it
yeah,
is
how
on
can I
the.
spend less time verifying whether a stock is Sharia compliant and spend more time analyzing Sharia compliant stocks to invest in?
Yeah, I mean that's why we built Zoya. I mean that removes
Right.
the pain of screening companies and determining what's Sharia compliant. That's just one quick filter away within the app. So if you download the app, go to the filters, you could say, set Sharia compliant status to compliant only. There's a number of other filters that we have as well. For instance, if you wanted to filter down to Sharia compliant stocks that have a buy rating by professional analysts, you could do that as well. If you wanted to shortlist a number of stocks, high dividend yield stocks, so on and so forth. All of that is very easily possible through our app. Another great strategy, by the way, that a lot of people don't think about is we support ETFs and mutual funds within Zoya, obviously, as we demoed earlier. But you can look up any kind of popular ETF and essentially mimic their strategy. So if you see a conventional ETF, maybe it's actively managed, maybe it's passively managed, doesn't really matter. But if they're already doing the hard work of determining which stocks are worthy of investing in, and that's why they include that in their ETF. In Zoya, you can actually see the full list of holdings that are consistently updated as they release new updates. So you can just see what these professional ETFs are holding, and then kind of use that as your way to shortlist which stocks that you want to be investing in. So I definitely recommend using Zoya to do that as well.
Thank you. So one of the questions was, is there a fee to consult with one of our advisors? There is no fee to consult with any of our ShariaPortfolio advisors. However, we charge a fee based on the assets under management. So if you choose to work with us, depending on the strategy that we're utilizing, because there is a different fee structure if you choose a passive, passive portfolio versus an actively managed portfolio, and also based on how much your total assets under management are for the household, we would determine what is the fee structure for that. But definitely, as a fiduciary, we are fee-only advisors, which means we're not, earning commissions or, selling this kind of product or that kind of product that is often, common in the industry among a lot of practitioners. So we try, we've always maintained a fee-only stance, and we would welcome, to discuss that with anyone who is interested in exploring how we might be able to add value in your investment journey. A 25-30-minute call you can have with one of our advisors where we can do a deep dive into your current portfolio, if you'd like, as well as, kind of giving a bird's eye view as to what we feel might be helpful for you. Some of you might be already on the right track, and that's fine. But for those who are looking for fine tuning, for those who are looking for assistance along the way, because let's face it, we all are busy. It takes time, it takes energy to analyze, to maintain, to monitor, and so that's where we can help you throughout your investment journey, and ensure that you're positioned well to achieve your financial goals. So I think we're at the 1 hour mark. There's a lot more questions. I can't go through all of them.
Maybe we
And
can cover two or three more if you want to
yes,
run over maybe another 5 minutes or so for anyone who
sure.
still wants to stick around.
Okay, let's see. Can you give examples? How does zakat factor into the standard 4% rule determined within the Trinity study if we're anticipating to give 2.5%? So I'm not sure what the Trinity study is, but I will comment on zakat in general. There's an article that we can share from our Sharia advisor on the topic of zakat and how zakat is calculated on stocks. I think you'll find that to be very valuable. Zoya also has a ability to calculate your zakat on their platform. So I will highly recommend folks to check that out. We are currently working on, for our current existing clients, ability for us to calculate zakat on their behalf and upload that into their client portal. So that's something exciting in the works. But I would definitely recommend, checking out what Zoya has in terms of how that can help you with calculating zakat. So if you don't mind, maybe Saad can just quickly showcase how to go about using the Zoya platform to help you with your zakat calculations.
Yeah, actually, I don't want to take up too much time, but
Sure.
I'll do you one better. So every Thursday, I actually personally host a webinar where I walk through all the features of the app and answer all your questions. So we have one coming up tomorrow, I believe, on the calendar. And if not, like I said, we host it every single Thursday. So feel free to join that. I'm happy to walk through all the different features and show you exactly what you need to do to
Perfect.
calculate your zakat or check out any of the other features
Yeah,
we
and
have.
if you're interested in the article that I was highlighting, just reach out to us and just mention that in the headline that, can you please share the Zakat article? We have prior recordings too on the Zakat webinars that we've done with various scholars, including Sheikh Umar Khan, our Sharia advisor. So you're welcome to check that out. But if you're looking for something quick to reference, we're happy to share that. And anyone who's interested can just quickly send us a line to info@shariaportfolio.com, and we're happy to send that over to you. Um, I think a lot of these we've probably covered in many of these. Let me see. There's something that Chinese companies are growing and gaining momentum globally. Which ones or which ETFs include Chinese champions that you're seeing? That's a good question. So, we have an SPWO ETF, which is developing world and emerging markets are kind of incorporated within that. And it's actually been a fund that has done quite well, especially this year in light of how the US markets relative to emerging markets have done. So I would say for those who are looking for emerging markets and Chinese company exposure, you can check that out. Um, valuation wise, I think, some of the equities in that, in the Far East Asia are trading, at a lower valuation relative to the US counterparts. So that's something to keep in mind. Of course, that doesn't mean that the US market, it does not have opportunities. It just means that, if you're looking to try and buy companies that are trading cheaper, equities in China, for example, might be lower in value, valuation wise. The other thing I'll mention is also SPTE, which is a global technology ETF. So you're also getting exposure to technology companies that are, more on the global side and less, not necessarily just US based. So companies like ASML or Taiwan Semiconductor, which have done quite well, are also, components of these ETFs that you can definitely check out. So just wanted to point that out for anyone who's interested in that. I'm sure you can explain. What research should one do and data that one should collect before investing in an individual stock? What level of data analysis skills do you need to do this? I think a lot of that depends on what exactly is your objective. Are you trying to, first know why you're trying to analyze a company? You always start with the big picture first before you go into a specific stock. I think ask yourself how are you allocating your portfolio? So look at the asset allocation, which is a balance between equities, sukuk, real estate, among other things. So start there and then ask yourself, okay, I've determined I want 80% of my portfolio to be equities. Well, what sectors are you going to want to have exposure to? So I think start there and say, do I want to have 80% all in, in technology, or do I want some of it in other sectors like healthcare? And so start, with that approach. And then let's say you determine you want to have 40 or 50% in technology. Which stocks are you interested in? And are you more comfortable with volatility, or are you looking for stability? And that will help give you ability to determine which types of companies you want to focus on. And then you start digging into the specific company in terms of the financial history, how long, how have their earnings been growing, what industry are they in, who is their competition, what are the future revenues looking like, and so You can do a financial analysis based on some of the financial ratios. You can do a fundamental analysis based on the industry that it is in and future growth prospects. So there's a lot that goes into this. You can rely on analyst research as well. So it gives you perspective on how people are evaluating that. Some of it might be paid research, some of it might be available online. So there is a lot that goes into the portfolio research, before making a determination as to whether or not we wish to buy any particular stock. So hope that helps anyone, because this is not just, there has to be a method behind this, and research and analysis definitely is a big role in determining what you wish to invest in. So hope that helps. Which financial institution is the guarantor of clients' investments? This is another good question, because people want to invest, but they also want to make sure their investments are safe. So in the case of ShariaPortfolio, if you were to open an account with us, we use Charles Schwab as the primary custodian. And so your assets are held at this reputable custodian that holds trillions of assets, trillions of dollars worth of assets for a lot of investors, not just in retail, but also institutions. And so you can have the same level of protections as any other brokerage platform affords, with FDIC, SIPC insurance, and things of that nature. So that gives you the peace of mind. Then we're basically, if you introduce us to invest, then there is an investment management agreement that allows us to invest on your behalf. So we're not taking over anyone's account. We're basically delegated the responsibility to manage the funds on your behalf, of course dependent on your age and all those different factors, but the custodian generally will be Schwab. Now in some instances the custodian could be other platforms, especially for 401k plans. If you're working at your employer and there is a brokerage or self-directed option, which I highly recommend those who are listening check that out, because it's a common thing that many people may not be aware, that your retirement plan may be already giving you the flexibility to choose your own investments. Because oftentimes when you log into your 401k portal, there is a list of 15, 20 mutual funds, target date funds maybe, that you can select from. Oftentimes, these are not going to be Sharia compliant. So how can you benefit from the halal choices? Well, ask your employer, ask the administrator of your plan, do we have a self-directed, do we have a brokerage option within our 401k? If the answer is yes, go ahead and enroll in that and take advantage of the halal funds through that approach. If you wish for us to invest on your behalf, then there is usually an agreement of some sort that we can go in and help manage that. But the platform for that is different. Again, we have to navigate based on whatever the 401k provider tells us. But all other assets that we manage, generally speaking, are held at Schwab, and that's how investors can have access online 24/7, just like they would for any of their other financial accounts.
So thanks again to Aliredha for the insights, and to all of you for attending. If you have any suggestions or feedback on today's webinar, feel free to reach out to us directly. We'll also be sending a follow-up email with the recording of today's session. Take care, and we'll see you at the next one. Assalamu alaikum.